Meet Mike. He's been trading for 2 years, which in Wall Street years is basically a toddler playing with matches and charts. His portfolio is up 13% this year, mostly thanks to a meme coin shaped like a dog wearing sunglasses. Mike's confidence has grown faster than his account balance, and his ego now requires its own margin account. He spends nights watching The Wolf of Wall Street and quoting it like it's an instructional trading manual. At bars, he lectures strangers about biotech companies he barely understands, while checking his Robinhood app every 30 seconds. Mike believes he's cracked the code to wealth, mistaking luck and liquidity for financial enlightenment. So he does what any overconfident beginner would: calls his broker, exaggerates his net worth, and requests options trading approval. Within hours, he's approved, holding a permission slip to gamble legally while calling it high conviction strategy. His trading plan is simple: buy high, sell higher, repeat until broke or famous, whichever comes first. His risk management system? A single whispered prayer and a screenshot of Warren Buffett on his phone background. Weeks later, he's leveraged to the maximum on Tesla calls and whatever meme stock is trending that morning. Mike's wife begins noticing unusual bank withdrawals, labeled strategic opportunities, which all end up as expensive lessons. "Where's our savings?" she asks. Mike answers confidently, "It's in the market, working harder than I ever could." 3 months later, the Federal Reserve hikes rates, and Mike's portfolio drops faster than his self-esteem. Down 67%, Mike's newfound financial freedom feels more like a hostage situation. His wife's new hobby is Googling how to divorce a man who calls himself a market wizard. But Mike's story isn't unique. It's the story of countless retail investors who mistake momentum for mastery. Which brings us to the big question: why do the dumbest investors seem to win the most? The answer lies in psychology's cruel comedy, the Dunning-Kruger effect, where ignorance breeds unshakable confidence. It's the curve where the least experienced shout loudest, and the most experienced quietly question everything. Since 2020, markets rewarded blind optimism. Every coin, stock, or trend line went straight up regardless of fundamentals. Buying anything with a ticker symbol made you a genius, at least temporarily, in the eyes of your group chat. Mike believed he had found the secret formula: buy hype, sell hope, and ignore the word valuation. Traditional investors spoke about earnings, debt ratios, and cash flow. Mike spoke about vibes, rocket emojis, and diamond hands. His success wasn't skill, it was the longest bull market in modern history, handing out participation trophies. 17 years, 715% returns. The S&P has been on a caffeine-fueled joyride since 2009. During that run, even companies without products somehow doubled, and everyone suddenly became a financial influencer. Mike's group chat called themselves the Alpha League, which was ironic because none of them knew what alpha actually meant. Still, they celebrated every gain with champagne emojis and blamed every loss on market manipulation. Dumb investors win because they embrace volatility without fear. They risk everything when professionals hesitate. Okay. In a rising market, recklessness masquerades as bravery and looks brilliant until gravity eventually returns. Mike's portfolio thrived in chaos because high beta stocks move faster, up and down, and then everything else. Let's talk beta, a measure of volatility comparing your stock's movement to the overall market's heartbeat. Amazon's beta, for example, is 1.33, meaning it's 33% more dramatic than the average stock. If the market rises 2%, Amazon rises 2.66%. When it falls 2%, it crashes equally harder. Retail traders love that roller coaster. The higher the beta, the bigger the dopamine hit per trade. Mike's entire portfolio is basically a high beta playground. Thrilling on the way up, disastrous on the way down. When the market rallies, he books dinner at Nobu to celebrate his financial genius. When the market dips, he Googles pay-way job openings and considers becoming a food delivery entrepreneur. Everyone looks like a genius in a bull market, until the music stops and the lights expose who was swimming naked. Eventually, the music stops. The Fed tightens, liquidity fades, and Mike's once glorious portfolio now resembles a tragic PowerPoint slide. His confidence melts faster than a meme coin rug pull, and humility finally knocks on his trading terminal. Overnight, Mike goes from self-proclaimed market wizard to a cautionary Reddit post with 200 sarcastic comments. The market punishes arrogance the way gravity punishes flight attempts. swiftly and without negotiation. Mike stares at his account graph, which now looks suspiciously like a ski slope after global warming. His reaction? It's fine. Long-term investor here. His wife quietly unplugs the Wi-Fi for everyone's safety. But hidden in this disaster is the real lesson. The Dunning-Kruger curve's other side. Awareness through pain. Confidence drops, curiosity rises, and suddenly the charts look less like opportunities and more like teachers. The smartest investors aren't loud. They're the ones who've lost, learned, and lived to trade another day. Dumb investors win in bull markets because luck loves the bold, but wisdom only grows through failure. Mike finally realizes his early victories weren't skill. They were statistical noise dressed as talent. He begins reading about diversification, risk management, and words previously banned from his vocabulary, patience and discipline. He now understands why seasoned investors care more about surviving than outperforming. Real investing isn't about catching every wave. It's about staying afloat when storms hit without warning. Still, new Mikes appear daily, fueled by TikTok traders promising Lamborghini returns from basement setups. They chant, "This time is different," ignoring the eternal truth. Markets change, human psychology doesn't. Every generation believes they've outsmarted the last, until the next correction proves humility is undefeated. So when does the bull run end? Nobody knows, and that uncertainty is the only certainty worth trusting. You have two options. Sit on cash like Buffett or go all in like a caffeinated casino enthusiast. One path compounds quietly, the other crashes loudly. Both teach the same lesson in different languages. The market doesn't care about your confidence, your spreadsheets, or your Instagram highlights, only your discipline. Mike chooses the boring path, learning that boredom compounds faster than excitement ever could. He no longer chases dopamine trades. He tracks habits, budgets, and sleep instead. For the first time, his peace of mind grows faster than his portfolio, and that's real wealth. Investing isn't a test of intelligence. It's a marathon of emotional endurance and self-control. The market rewards patience, punishes pride, and occasionally tips its hat to humility. Confidence is loud, but wisdom whispers, and only those listening quietly actually hear it. Mike's ego shrinks, his understanding expands. He now trades less, learns more, and finally enjoys weekends again. His wife stops Googling divorce lawyer and starts Googling best long-term ETFs. Progress at last. Every crash has two victims, the portfolio and the ego. Only one can recover with time and reflection. Mike's journey proves that losses aren't failure. They're tuition, and the market always collects its fees. He now teaches new traders. You don't need to be smarter than the market, just less stupid than yesterday. Discipline doesn't trend, but it compounds quietly while hype burns out spectacularly. Everyone looks like a genius in a bull market. True wisdom appears when prices fall and courage hides. The dumbest investors win because bull markets reward recklessness, not intelligence. Until the music stops. And when it stops, only those with humility left still have capital to play another round. Mike now smiles when others brag about 10-bagger trades because he knows how that movie ends. Sometimes the biggest win is simply not losing when everyone else is bleeding red. Success isn't measured by your gains in euphoria, but by your discipline in panic. So, stay humble, stay patient, and remember, the dumbest investors win, right up until reality checks the balance.